In 2025, even a small change in your mortgage rate could mean tens of thousands of dollars saved or lost over the life of your loan. So how do you lock in the lowest rate possible, especially in a market filled with uncertainty? Whether you're a first-time buyer or refinancing, this video gives you the exact steps to follow. Stick around to the end. You'll walk away with the knowledge to outsmart the system and save serious money. Getting the lowest mortgage rate in 2025 isn't luck, it's strategy. And to play the game right, you need to know how the system works. Your mortgage rate is determined by a mix of market factors and personal factors. The market side, things like inflation, economic growth, and Federal Reserve policy, are out of your hands. But what you can control makes all the difference. Let's start with your credit score. In 2025, lenders are more risk-averse than ever. A credit score above 760 gets you the best rates, while a score below 620 can mean you'll pay thousands more in interest. Even a 20-point jump could save you 0.5% on your rate. That adds up fast. To raise your score, pay down credit card balances to under 30% of your limit. Make every payment on time, even your $15 Netflix bill. Avoid applying for new credit before your mortgage. Check your credit reports for errors and dispute them early. Second, there's your debt-to-income ratio, DTI. Lenders use this to gauge how much of your income is already spoken for. A lower DTI, ideally under 36%, means you're less of a risk and more likely to qualify for lower rates. This is why paying down debts before applying is one of the smartest moves you can make. Third, think about your down payment. The more you put down, the less risk for the lender, and the better your rate. Aim for 20% if you can. Not only does this reduce your loan amount, but it also helps you avoid private mortgage insurance. PMI, another monthly cost that adds up. Then there's loan term and loan type. Shorter terms like a 15-year mortgage often come with lower rates compared to 30-year loans, but higher monthly payments. And certain types of loans, like conventional loans, may have more favorable rates than FHA or VA loans, depending on your financial profile. The key is knowing what loan product fits you best, not just accepting what's handed to you. Now that you know what lenders are looking at, let's get tactical. Because in 2025, the buyer who shops around wins. Tip number 1. Compare at least 3 lenders. A 2023 Freddie Mac study showed that borrowers who got quotes from multiple lenders saved an average of $1,500 over the life of their loan. And that number's even higher now. Don't settle for the first offer. Mortgage rates can vary wildly from one lender to another based on their internal risk models, the type of property, and even the state you're buying in. You can even use one lender's offer to negotiate a better deal with another. Lenders compete for your business. Let them. Tip number 2. Consider paying discount points. Points are upfront fees you pay at closing to buy down your interest rate. 1 point equals 1% of your loan amount, and typically reduces your rate by about 0.25%. If you plan to stay in the home for a long time, this could save you a lot in the long run. But if you're only staying for a few years, it may not be worth the upfront cost. Run the numbers. Use online calculators or ask your lender to show you break-even points. Finally, stay organized and responsive. The faster you can get documents in, the less likely your rate lock will expire. Rates can go up quickly. Don't lose your spot in line because of paperwork delays. Want a step-by-step mortgage rate checklist you can use today? Comment "mortgage" below, and I'll send it your way. And if you found this video helpful, hit that like button, subscribe, and turn on notifications. We've got more insider tips on the 2025 housing market coming your way every week. Your dream home is possible, and it starts with the right rate.